Good morning, ladies and gentlemen. Well, we had the Trump shooting last night, but the markets don't seem to be wildly affected. I think the fact that he was a 20-year-old boy being silly is probably the reason why nothing has happened really in the markets, and these are the current prices of CFDs. As you can see, Wall Street, i.e., the Dow is down 50, but tech is up 6. So, really, very little change. And even in the currencies, very, very little change indeed. I think probably on Monday we'll get some more reaction, but let's examine what the real trends are and not forget that all that's happened is that the odds that were at 58 for Trump winning have gone from 58 to 63, 64. So they've just increased. It's not a change in trend, it's a deepening in trend. And the results of that should be, I wouldn't say negligible, but I would say limited. So let's have a look at what the longer term trends are and what trends are likely to reinforce themselves once the market has basically done whatever hedging it needs to do on this event. The big event of last week was the CPI and how inflation is now falling towards the dot plots that the Fed has. Although the PPI was slightly higher, when you calculate the PCE from it, you basically get a figure which is at the dot plots that the Fed has for the end of 2024, i.e., we are on track for satisfying what the Fed needs to see in order to have the two cuts in 2024, which it has penciled in into the dot plots. So we're on track. And the short end is reflecting that. The short end naturally moved the most, the long end moved hardly at all. I will repeat what I think is going to happen here. We are going to have a shallow cutting cycle from 535 to 4, or maybe slightly lower than 4, and we're going to keep real rates somewhere around in the range of 1.5 to 2%. I think that is what the Fed sees as still needed to squeeze and keep on squeezing inflation. And the only reason why they would bring real rates lower than that is if unemployment starts spiking. Well, we saw from the data last week that unemployment is not spiking. We are just getting more of the same, i.e., a labor market which is in better balance rather than a labor market which is deteriorating. But people will always extrapolate and look for something to move forever in one direction. I think the safest trade out there, which Trump compounds, is the steepener. So let's have a look at 2s10s. I was actually surprised that they kept on going last week, but then the data enabled them to keep going. If we get to these levels, I'm going to get out of my steepeners because I think it's too much too soon. So anywhere between 20 and minus 16, I will be out and looking to re-establish on a bounce back. 2s10s and 5s30s are the favored steepeners, and 5s30s, to my surprise, has gone more. But then when you're buying 5s, you don't really have to worry about the immediacy or the exact timing of the steepener. You have much more time. The belly has much more time to be right, as it were. This is the kind of level that I think you no longer want to be in it for the time being, i.e. minus 37. Minus 37 tells you really basically that it's more likely to remain stable or even go a little bit higher before it starts going lower. So I'm not looking for a huge amount of steepening, but I'm definitely looking for a continued steepening, and the real steepening is only going to happen when the unemployment data somehow confirms or shows an acceleration in unemployment. I don't think the Fed will react before that. The Trump news is positive for the steepener. It should steepen more because Trump's policy of cuts and pressuring the Fed to lower short-term rates is a natural steepener, simply because there is no end in sight to the huge budget deficits of the US, and therefore it keeps the long end stable and all the money goes into the short end of the curve. Don't forget, I keep on telling you this, there's $4 trillion in money markets trapped into the 3 month, and even that is rolling over. At some stage soon, these guys are going to need to go into the 2s, the 3s, or maybe even the 5s. I think it's a bit late for them to go into the 5s, but my favored are the 2s and especially the 3s. To me, the 3-year note at some stage over the medium term will trade down here again, while nothing much else will have changed for the 30s. If you look at the 30s, they are the ones that did the least last week, and they will continue to do the least. I find it very difficult to believe that 30s are going to fall much below 420, whatever happens to the short end, especially if the short end goes down quite a bit, because people will be doing the steepener. No reason at all to believe that this cutting cycle will be anything but shallow, and that the pressure from issuance, from long duration issuance, remains at the long end. Where would I start arguing with bonds? I haven't been arguing with them on the way down, and this is now the 10-year note. I will start arguing in this area between 407 and 399. I don't see any reason why the longer end, i.e. 10s and 30s, would go much lower than this, and this would be a good area, I think, to look for put spreads on the futures, to look for it to go back towards 428, simply because I just can't see anything but a shallow cycle from the Fed, and I don't see an acceleration of unemployment. If we, on Monday or whenever, we get a flight to quality, and as a result of Trump, which I doubt, I don't think it's going to happen, but I'm just saying in case it happens and we see these kinds of levels around 407, I would be looking to short the 10-year note. And this is just a short-term tactical trade that I'll be looking to do. You never know what people need to do and who panics and why, but that's the kind of level that if we see on the open or just after, we really should take advantage of, because this is likely to be a nothing burger. Nothing much at all is happening in Europe, but what is interesting is that the French against the German spread on the 10s has basically returned to an area where the risk reward is no longer to be long of France against Germany. I think at this 62 level, you need to be out and not even thinking about it. And also against France, Britain, we're getting to levels where really it's not really worth thinking about it anymore. This kind of 97, 98 level is unlikely to go a million miles, and I'll be out on Monday. Haven't made very much, but I just don't see the point of being too long here of France. I think France has basically returned to levels which makes sense because how shall I put it, the dangers that France will encounter over the next few months with the new government are substantial, and I really don't think that returning exactly to where we were before the election makes a huge amount of sense. At these levels, I'd rather be long of other markets against France rather than the other way around, because I think the dangers are still there. As far as Britain is concerned, I think the nightmare will start after the budget, and therefore, for the next 2 or 3 months, it's probably worthwhile being out and then re-establishing whenever the budget is in October. The only interesting thing that is happening in Europe is actually the spread against the US. This is now 2s, and you can see the trend. I think it's going to be very difficult to bust this area here, but have a look at where we were in January and then compare to where the dollar was in January. And I think that this chart is basically just a dollar chart inverted. We are likely to go back down and continue this trend. Naturally, Monday and Tuesday could be slight reversals of that trend, but I'm not worried in the slightest. I think this is going to give us opportunities to put this spread on. So those are 2s. Let's have a look at 5s. Same trend, bust the line. We are going down towards these kind of levels. So this is new highs for, or new lows for this spread in 2024. The trend is now confirmed as one that is going to go down towards 135. Let's have a look at the 10s. Again, 2024 new lows we've broken. We might come back up towards 178, 180 on Monday and Tuesday as a knee-jerk reaction to an assassination attempt, which tends to favor the dollar, flight to safety and all that. Great, let's put the spread on. I think it's much more likely to head down towards 152 and take the dollar with it. Any kind of bounce now towards this 180, 182 area, I'm ready to put the trade on and the dollar trade on much more. And here we have DXY. I think we are likely to see a retracement on the Trump shooting to about 104.56, and there I am ready to start buying puts on the DXY or calls on Euro USD. I think, as I showed you in the previous chart, the fact that we closed below 172 on the 10s and that the 2s and the 5s look like they're breaking down for the 2024 new lows, to me indicates that those spreads are coming in. And the fact that those spreads are coming in is naturally going to take the dollar down to levels where it was around the beginning of 2024. And while this might have been an exaggeration, I'm certainly looking for the dollar to come down to around 102.30, 102.35, as you see in this kind of level. If we translate that to euro, I think that at some stage we are likely to revisit just above 110, not a lot above 110, but that kind of area I see as the natural area where we will trade. This is where we started 2024, and this is where we will revisit 110.12. Gold is trading with the dollar and the bonds, so it's not surprising that it started breaking higher. It should be favored, and I can't see it really opening anywhere but up. However, around this 24.8, 24.38, 24.40 level, I think it's probably going to come back from there, simply because I just don't see that this was a significant worldwide effect. As I told you at the beginning, it's just pushing at a string, i.e. Trump is already leading, and this makes not much difference to that. Therefore, a spike higher, I think, is a first sell for a return back to where it was. And then I think we do try these all-time highs again, 2480, but I think that we fail at them, or we just spike and we come back. I don't think gold is going to be a primary beneficiary here. I just don't see any reason not to buy tips instead. DBC is remarkably stable. It's really not doing anything at all, and even its ratio to gold is not doing anything much at all. I don't think that this is the time to be playing in commodities. I just don't see that there's any point to it. I find it incredible to think that oil is as well behaved as it is and trading technically so well. Basically, you want to buy it every time that it's below 75 and you want to sell it around the 85 area. So it's in a $10 range and it's maintaining its stability in that $10 range. And while that happens, DBC can do absolutely nothing apart from remain in a tight range. While this is happening, there is absolutely no reason for the Fed to fear any kind of inflation reacceleration. And since that is the case, that compounds the probability that the steepener will continue to work. In equities, really, it's all about this monthly Bollinger Band. I just can't see it being able to remain above there. The Bollinger Band now, it's 56.46. So above 56.50, you really don't want to know about the SPX. It's unlikely to be able to maintain those levels. Now, I'm not saying that it's going to go down a lot, because if you have a look at all these charts, including the weekly, it's above the Bollinger Bands, which to me says it's a strong market, but it's a market which cannot sustain the gains that it's made straight away. Now, is the Trump assassination attempt bullish for equities? Well, Trump is equities over bonds. I think you could get high volatility within a relatively narrow range. I think there will be buyers on any big dip, but I think that you are likely to get those dips as people rotate. We saw last week the beginning of some rotation, and we'll look at that in a few minutes. I just don't buy the arguments for the long-term duration into broadening at the moment. Just don't see the reason for it, because if you're going to have a steepening yield curve, that actually helps the big companies as opposed to the little ones, because they're not going to get any relief from high rates at the long end. And they borrow the long end, they don't borrow the short end. So we've probably seen everything that benefits the smaller companies. But here we are. I just think any kind of move down on, flight to safety or whatever, you need to buy. There is no way in the immediate future that I can see that the SPX is going to trade below 53, 52. I mean, absolutely none. And I think it's far more likely that we maintain even levels, and we'll look at my clean chart. I just don't think there's much chance that we come down below 55.15 anytime soon. That is the next level that I'll be marking. I think it's a strong market, but one which is going to go sideways and try to stop some people out. So let's have a look at the arguments for rotation. Okay, so this is XLK on a monthly. Now let's take it down to a weekly. Now let's take it down to a daily. It's right at the top of all the Bollinger Bands, and that tells me that it needs to stop and retrace and consolidate. Now let's have a look at a spread of something like NDQ over DJI. Is this a bearish pattern? No, it's just a pattern which says that we're going to go sideways some while the XLK consolidates for best part of probably 2 months. It goes sideways and then it starts going higher, and that is all there is to it. I think even if you look at NDX over IWM, this is not a bearish pattern. I think it's still continuing. It's just a market which needs to go sideways for a bit before it reestablishes its trend. So what I think we saw last week is people getting out of the big names that dominate the SPX and that dominate the NDX, simply because they've gone up so much over such a short period of time, and technically they're exhausted to the upside. Now when that happens, money starts leaving them, and where does it go? Well, does it make much sense that it goes into other assets apart from equities? To me, no. To me, it's still a equities over bonds trade. It's still risk on, and therefore it makes sense to keep the money in equities. Well, if everything that I own is already at the top of the monthly, weekly, daily Bollinger Bands, what do I buy? Well, I rotate into something which is at the bottom of those Bollinger Bands, right? And that is basically the Russell stocks. So it's a technical phase at the moment. I don't think it's a fundamental phase at all. So let's have a look at the Russell, and let's have a look at the monthly chart. And you can see that all that happened is that they took it to the top of the monthly Bollinger Bands. That's it. To me, this is a technical rotation of people who didn't know what to do with the money they had now from the sale at the highs of the tech, and therefore they put it into work or covered and made some people cover shorts in the small caps. I don't think that this is going to be the start of a buy small caps, sell big caps. I think it's a technical trade. Can it last some longer? Absolutely. It's not. What we've done here is we're breaking out slowly out of this range. And let's have a look. And we're going back towards this range. Could it be that we go sideways in SPX and NDX for a couple of months, i.e. 4 bars to 8 bars here, and that we touch these levels in the meantime, 225? In IWM, absolutely possible. But does that mean that we are starting a new trend whereby people buy small caps and sell the big caps? I just can't see it. I think this is going to be a week in which the dollar is going to show what it's made of. If it can't keep its gains on Monday, it's going to show you that it's actually basically weak. Trump should be good for the dollar, and the Trump assassination should be good for the dollar. And if it's not, if it only gains a very small amount and the differentials in the tens between Germany and the US does not move very much, although it should, that actually gives you the tell that the dollar is about to move and that we're going to get the 110s in Euro USD. So that is what I'll be concentrating on, and otherwise I want to get out of the French market simply because the risk reward now is not great. We're within 4, 5, 6 basis points of where we were against Germany, and that is not worthwhile having. And we're within 10 basis points of where we were against Britain and the gilts, and that is not worth holding either until much closer or after the budget in the UK. So those trades go out of the window, and the one that I'm going to be looking at like a hawk because I want to ramp it up is short dollars. Thank you very much indeed, and tweet you tomorrow.